In 2000, tech executives were selling before the dot-com crash. In 2021, insider selling surged right before the bear market began. And right now, in 2025, that same pattern is playing out again. Insider selling has hit an all-time high. Cash reserves across Wall Street have reached historic levels. The bond market just ended its longest warning signal ever recorded. The ultra-wealthy don't have crystal balls, but they watch 3 specific indicators that have predicted nearly every major crash in modern history. And by the end of this video, you'll know exactly what those signals are. Here's the thing about billionaires that most people get wrong. Everyone assumes they have some secret hotline to the future, some exclusive club where they share insider information over champagne and caviar. The reality is far less glamorous, but infinitely more useful. The ultra-wealthy don't predict crashes. They prepare for them by watching the same economic indicators that are publicly available to anyone with an internet connection. The difference is they actually pay attention, and they act decisively when those indicators start flashing red. The first signal billionaires watch obsessively is something called the yield curve, specifically when it inverts. Now, before eyes start glazing over, let's break this down into plain English. When you lend money to someone, you expect to be paid more if you're lending it for a longer period, right? If a friend asks to borrow $100 until Friday, that's one thing. But if they want it for 10 years, you'd probably want something extra for tying up your money that long. This same logic applies to government bonds. A yield is simply the return you get on an investment. When you buy a US Treasury bond, you're essentially lending money to the government. A 2-year Treasury bond should logically pay less interest than a 10-year Treasury bond, because you're locking up your money for a shorter time. When everything is normal in the economy, the yield curve slopes upward like a ski slope. Short-term bonds pay less, long-term bonds pay more. Simple enough. But here's where it gets interesting. Sometimes this relationship flips completely upside down. Short-term bonds start paying more than long-term bonds. This is called a yield curve inversion, and it's been the single most reliable predictor of recessions in American economic history. The yield curve inverted before the 2008 financial crisis. It inverted before the dot-com crash in 2000. It inverted before the 1990 recession. In fact, the yield curve has inverted before every single US recession since 1955, with only one false signal in the mid-1960s. That's an accuracy rate that would make any weatherman weep with envy. Why does this happen? When investors believe the future looks grim, they rush to lock in long-term returns while they still can. This massive demand for long-term bonds drives their yields down. Simultaneously, if the Federal Reserve is hiking short-term interest rates to fight inflation, short-term yields climb higher. The result? An inverted yield curve. It's essentially the bond market screaming that something is very, very wrong. In March 2022, the yield curve inverted. By June 2022, the stock market had officially entered bear market territory, down more than 20% from its peak. Ray Dalio, the billionaire founder of the world's largest hedge fund Bridgewater Associates, had been warning about this exact scenario for months. Warren Buffett's Berkshire Hathaway had been stockpiling cash like a squirrel, preparing for nuclear winter, eventually sitting on over $140 billion in reserves. These men weren't lucky. They were paying attention. The second signal is, perhaps even more telling, and it involves watching what corporate insiders are actually doing with their own company stock. Forget what CEOs say in interviews. Forget the optimistic earnings calls and the confident press releases. Watch what they do with their own money. When executives start selling their shares in unusual volumes, it's time to pay very close attention. Corporate insiders, which include executives, directors, and major shareholders who own more than 10% of a company, are required by law to report their stock transactions to the Securities and Exchange Commission. This information is publicly available through something called Form 4 filings. It's not hidden in some secret database. Anyone can look this up. Yet most retail investors, meaning everyday people putting money into the market, never bother to check. There's a crucial distinction to understand here. Insiders sell stock all the time for perfectly innocent reasons. They need to diversify their wealth, pay for a new house, fund a divorce settlement, or buy another yacht because apparently one yacht is never enough. This kind of selling is routine and often happens on predetermined schedules called 10b5-1 plans. These plans are set up in advance and execute automatically, removing any suspicion of trading on insider knowledge. What billionaires watch for is cluster selling, when multiple executives across multiple companies start selling outside of their normal patterns, all around the same time. This is the canary in the coal mine. When the people who know their businesses best are quietly heading for the exits, it usually means trouble is brewing beneath the surface that hasn't shown up in the public numbers yet. The data on this is striking. Research from academic institutions, including the University of Michigan, and studies published in financial journals have consistently shown that heavy insider selling tends to precede market downturns. A 2021 study found that when insider selling reaches extreme levels relative to insider buying, stock returns over the following 12 months are significantly lower than average. Look at what happened before the COVID crash in early 2020. While most people couldn't have predicted a global pandemic, insider selling in January and February of that year reached unusually high levels, particularly in travel, hospitality, and retail sectors. Some executives clearly sensed weakness in their businesses before the world locked down. Senator Richard Burr famously sold up to $1.7 million in stock after receiving classified briefings about the virus, which landed him in legal hot water. But the point remains. Those with the best information often act before the rest of us even know there's a problem. The key metric to watch is the insider buy-sell ratio. When this ratio becomes heavily skewed towards selling, typically when there are more than twice as many sellers as buyers among corporate insiders, red flags should be waving. Several financial websites track this data in real time, including FinViz, Open Insider, and the SEC's own Edgar database. Stanley Druckenmiller, the legendary investor who worked with George Soros to break the Bank of England, has spoken publicly about incorporating insider activity into his analysis. When he sees executives fleeing their own ships, he takes notice. And right now, according to data from Verity Data, insider selling has reached an all-time high. The ratio of sellers to buyers among corporate executives is more aggressive than at any point in the past 2 decades, exceeding even the peaks before the 2008 financial crisis and the dot-com collapse. This is happening while markets hover near record highs. That's not a coincidence. It's a pattern that has repeated itself over and over again, and the smart money is clearly taking notice. Which brings us to the third signal, and this one might be the most straightforward of all. It doesn't require understanding bond markets or tracking SEC filings. It simply requires watching what billionaires do with their cash, not their stock portfolios, not their real estate holdings, their actual liquid cash reserves. When the wealthiest investors in the world start hoarding cash at unusual levels, it's a signal that they don't see attractive buying opportunities anywhere, which usually means they think the market is overvalued and due for a correction. Warren Buffett has been using this strategy for decades. The man nicknamed the Oracle of Omaha has a remarkably consistent pattern. He lets cash pile up when he thinks stocks are expensive, then deploys that cash aggressively when prices crash and bargains appear. Before the 2008 financial crisis, Berkshire Hathaway's cash reserves ballooned to $44.3 billion. When the crisis hit and everyone else was panicking, Buffett went shopping. He made legendary deals, including a $5 billion investment in Goldman Sachs, with incredibly favorable terms that only a buyer with deep pockets could negotiate. The same pattern emerged in late 2021. While retail investors were pouring money into meme stocks and speculative assets, Buffett's cash allocation hit record highs. Within months, the market topped out and began a brutal 20% decline. Fast forward to today. As of late 2025, Berkshire Hathaway is sitting on approximately $382 billion in cash and treasury bills. Let that number sink in for a moment. That's more cash than Apple, Amazon, Alphabet, and Microsoft have combined. It's enough money to buy every single NFL team and every single NBA team and still have billions left over. Buffett has been a net seller of stocks for 12 consecutive quarters. He slashed his Apple position, a stock he once called probably the best business in the world. He trimmed Bank of America, financial stocks, and various other holdings. The man who built his fortune by buying and holding great companies for decades has spent the last 3 years doing the exact opposite. Buffett isn't alone. Across Wall Street, major hedge funds have been building cash positions and reducing exposure to equities. The reason comes down to a concept Buffett himself popularized, often called the Buffett indicator. This is a simple ratio that compares the total value of all publicly traded stocks to the overall size of the economy, measured by gross domestic product. When stocks are worth significantly more than the entire economic output of the country, it suggests the market has gotten ahead of itself. When stocks are cheap relative to economic output, it suggests bargains are available. Right now, this indicator is at its highest level since 1947, higher than before the dot-com bubble burst, higher than before the 2008 financial crisis. The previous peaks in this indicator occurred just before the two worst market crashes in recent memory. That doesn't guarantee a crash is imminent, but it does explain why billionaires are sitting on the sidelines with mountains of cash rather than deploying it into stocks. There's another dimension to this cash hoarding that often gets overlooked. When interest rates are elevated, as they have been throughout much of 2024 and 2025, holding cash isn't just a defensive move, it's actually profitable. The majority of Berkshire's cash pile is invested in short-term treasury bills earning around 4 to 5% annually. That means Buffett is generating billions of dollars in risk-free income while he waits for better opportunities. He's getting paid to be patient. Not a bad position to be in when stocks are expensive and uncertainty is high. Now, here's where all three signals converge in a way that should make anyone paying attention sit up straight. The yield curve just ended its longest inversion in recorded history, spending over 2 years in inverted territory before finally normalizing in late 2025. Historically, recessions don't hit during the inversion. They hit after the curve uninverts, typically within 6 to 12 months. That window is right now. Insider selling has reached extreme levels not seen in 2 decades, and cash reserves among the world's most successful investors have hit all-time highs. All three signals are flashing simultaneously. This doesn't happen very often, and when it does, it has historically preceded significant market turbulence. Does this mean a crash is guaranteed? Absolutely not. No indicator is perfect, and the economy has a way of surprising everyone, including billionaires. The yield curve has had one notable false signal in its 70-year track record. Insider selling can spike for reasons unrelated to market conditions. Cash hoarding could simply reflect a lack of attractive deals rather than fear of a downturn. Markets can stay irrational longer than anyone expects, and timing a crash is notoriously difficult even for professionals. But here's the crucial point. Billionaires don't try to time crashes perfectly. They don't sell everything the day before a collapse and buy everything back at the bottom. What they do is manage risk. They reduce exposure when warning signs accumulate, preserve capital when uncertainty rises, and position themselves to take advantage of opportunities that emerge during periods of panic. The goal isn't to predict the future with precision. The goal is to avoid catastrophic losses and remain flexible enough to act when others are frozen with fear. This approach is available to anyone. The yield curve data is published by the Federal Reserve and updated regularly. Insider trading information is freely accessible through the SEC's EDGAR database and various financial websites. Market valuation metrics like the Buffett indicator are tracked by dozens of sources online. None of this requires a Bloomberg terminal or a team of analysts. It requires attention, patience, and the willingness to act on information that most people either don't know about or choose to ignore. The wealthiest investors in the world aren't smarter than everyone else. They aren't privy to secret information that regular people can't access. What separates them from the average investor is discipline. They watch the signals, they respect what the data is telling them, and they make difficult decisions like selling stocks that have made them fortunes when the evidence suggests risk is elevated. Most people can't bring themselves to sell when prices are high because it feels wrong to exit a winning position. Billionaires don't have that emotional handicap. They follow the signals regardless of how it feels. Right now, those signals are sending a clear message. The bond market is emerging from its longest warning period in history. Corporate insiders are selling at record levels. The smartest money managers on the planet are sitting on unprecedented piles of cash. None of this guarantees what happens next, but ignoring it would be foolish. The information is there for anyone willing to look. So here's the bottom line. Keep an eye on the yield curve, particularly the spread between the 10-year and 2-year Treasury bonds. Track insider selling through free resources like Open Insider or the SEC's website. Watch cash levels at major investment firms and pay attention when legendary investors start hoarding rather than deploying. These 3 signals won't tell you exactly when a crash will happen, but they will tell you when the odds are shifting. And in investing, that edge is everything.